following paid commercial program is brought to you by TD Wealth.
Hello and welcome to Money Talk. I'm Kim Parley. Thanks so much for joining us. As expected, the U.S. Federal Reserve has hiked interest rates by 25 basis points. The hike comes as policymakers also deal with a wave of banking turmoil in the United States. Priya Misra is Global Head of Rate Strategy at TD Securities. She joins me now from New York. Priya, thanks for joining us. I know you've been talking about the Fed. We talk about the Fed all the time, but especially on days like today when there's a lot of people asking questions. Can I ask you now, we're a few hours past and the dust has settled. Was there anything that came out that was surprising? We were expecting a 25 basis point increase. Was there anything there that really caught your attention?
Sure. So they hiked, as you said. The dot plot suggests one more hike. To me, what was surprising was that the Fed is taking the banking turmoil seriously. It's only been 2 weeks really since SVB went down. But what we heard from Chair Powell today was that's likely to tighten financial conditions, banking, lending standards, and that significant number of Fed officials incorporated that when they were forecasting the economy for this year as well as interest rates. So, if you look at the rate market, you'd almost think that the Fed cut rates because even though they hiked, they gave a very dovish guidance. Meaning, it could be that there are not too many hikes after this because the Fed is concerned about the implications of the banking crisis on the economy. So I think that was interesting that they didn't sort of downplay it. They didn't say that this is an idiosyncratic few bank problem. I think what we heard was that they are very attentive to the implications that the tightening in financial conditions could have on the economy.
They were careful in how they said that, though, Priya. They did highlight that as something that probably contributes to putting a brakes on the economy, which helps, to your point. But they did say that it's a sound and resilient. And when they spoke about the banking industry, do you think there's more to come on that?
Yes, I think, it might be strong and resilient, but you've had the largest bank fail since 2008. And, I think the issue is that there was a liquidity problem with Silicon Valley Bank, but it wasn't just liquidity. The longer that this crisis is not resolved or the liquidity issues remain unresolved, I think this can morph into a capital issue. Credit Suisse, you can argue, was a capital and a liquidity issue. So, I think that we haven't yet seen what we're calling the circuit breakers. I think an FDIC unlimited insurance, deposit insurance guarantee will be a very important step. Not clear that we're going to get that. Chair Powell kept saying depositors are safe. But there is no FDIC unlimited guarantee, and the Fed can't provide that. That needs Congress. So I think that's a key step. Is there any capital? Is SVB going to be bought by someone? I think we're going to look for both public and private sources of capital. I think the fundamentals of the crisis need to be resolved. The Fed does have the liquidity facility, so hopefully banks access it. We get the estimate, or we'll get how much the Fed facilities were used every Thursday. So we'll see that tomorrow. But I think they've done what they could on the liquidity front. But really, it's up to Congress whether they do something with the FDIC or do they provide more capital or some sort of government backstop to allow private capital to come in. I think those questions are still out there. So the uncertainty remains very high on the banking crisis front.
What do you see in the next little while, or what are you watching, I'll say, over the next 6 months, 1 year? Inflation, before this happened was the big shiny thing that people were paying attention to. We are seeing it steady. In Canada, at least, it's starting to come down a little bit. What are you going to be watching to understand what the Fed will be watching over the next 6 months?
Sure. So I think the variables that the Fed's watching has definitely widened. I'd say 3 months ago, it was largely inflation. I think now it's inflation and it is the fallout of tighter financial conditions. So I think they'll be looking at credit creation, bank lending growth, deposit growth, and then the implications on hiring. So I think while they look at the fundamentals of inflation and the labor market, I think they'll be looking at high frequency indicators of how this tightening in conditions is impacting the economy. So I think all of this will come in. And that's why I think they keep the path slow. We expect another 225 basis point hikes. We say this with some caveats in there, assuming that no other bank goes under. But I think in the near term, we'll be watching how the bank crisis is unfolding. Longer term, what is the impact of the tightening that we've just had on both growth and inflation. So I think we'll be looking at a lot more variables this year, and the Fed is data dependent and nimble. So expect volatility to stay high.
You say a couple more 25 basis point hikes coming, that is with an asterisk. So I appreciate that you mentioned that. But after that, I mean, the one thing that kind of I think paid everyone's attention when these rates went up was the rate at which they went up. Are you expecting cuts after these 25 basis point hikes are done? Or are you expecting it to hold steady? And could we see some effect of, almost the inverse of what we have right now if rate cuts come in quite quickly?
Sure, great question, because the rates market priced in the imminent end of the hiking cycle and immediate cuts. And I think that we do struggle with. I mean, the economy is strong. I think the banking turmoil is going to be a longer term drag on the economy. And we do expect a recession later this year. We expect rate cuts later this year. But the market's pricing in the first cut by July, the first 25 cut right after the Fed stops hiking. I think that requires a Lehman type moment. I think if you have a large scale bankruptcy or big deleveraging pressures across the banking system, something like a sudden stop, I think the Fed turns around and cuts. But if it is a slowing down of the economy, a recession later this year, I think they'll be on hold for a while. And it's only once they see signs that the inflation numbers are starting to come down or wages are starting to come down because the unemployment rate is rising, I think then they start cuts. So I think they can be more patient with rate cuts unless we have a significant financial crisis at hand.
Priya, it's always great to get your perspective. Thanks for taking the time today.
Thank you.
Priya Misra, Global Head of Rate Strategy at TD Securities. Still ahead, how today's rate decisions and the uncertainties in the financial sector are impacting the commodities space. We're talking gold, we're talking oil with Bart Mellick of TD Securities right after this.